I'm Charlotte McLeod with investingnews.com, and here today with me is E.B. Tucker, editor of the Tucker Letter. Thank you so much for being here. Great to see you in person.
Yeah, great to see you. Thanks for having me.
Yeah, the first time in a long time in person, so very exciting. And we're going to follow up today on a really good conversation we had back in October. You shared your thoughts on the next 90 days for gold, and I think we're basically at that 90-day mark. So I'm going to check my notes here and make sure I get it right. You had said we could see a move in gold to 2150, maybe even 2200. And I believe gold did briefly get past that 2150 area. So it's pulled back, but still remains high. And I wondered if we could look at the next 90 days.
Yeah, so I think what if you're looking at this, what you're seeing is that we're maintaining this all-time high level, and every reason is out there for gold not to be doing great. The economy is very slow. Real rates are acting in a way that would normally predict for gold to be struggling. The yield curve is no longer inverting. It's now trying to reverse that. There's a lot of heavy things happening, and you would think gold would be weak during that time, but it's very strong. And I think we're going to move up to that 2150 to 2200 trading level by the middle of the year. I mean, this is something that I see happening by the middle of this year. I think there's other things we could talk about that are indicating that that's right, and that'll be our new little zone to be in. But people need to make a choice. Like, there's two ways to play gold. One way to play it is you can buy it and own it, and you can kind of use it as a way to protect wealth, which is really hard to accumulate. And the second way is you can be a trader. And if you want to be a trader, these moves of 1%, up, down, like every single day, the Fed says they're going to do something with rates. Oh, it's down. Oh, it's back up. It's just to get you in a spin cycle. But if you want to be a trader and you just want to trade it and you don't care about preserving wealth, you just want to play it, this is really good. But I've never been that interested in that because I feel like it kind of, at the end, you lose. I mean, you win the battle, you lose the war type thing. So I'm much more like, I want to win the war. I don't really care about the little skirmish.
So you can do either. You just need to know who you are.
That's right.
And what you're doing.
This is the secret of life, right? Yeah. You're going to do anything you want if you're honest with yourself. You say, this is what I do. So anyway, that's what you have to do with the gold market. So here's how I'm going to play it. Because people think it's going to go to like 10,000. Well, I mean, maybe, but like that would imply that the gold value in the world would be something like, 50 trillion plus or something like that. It's like, I don't know if that's really realistic. I mean, it doesn't really match with the rest of the assets that are around. It doesn't make any sense. And so I think what you see is that we're moving up. So we keep moving up in these little directions, and gold is like heavily traded. I mean, I watch it on the Bloomberg every day for decades now. And I mean, you'll trade in an active day, you'll trade half a year's worth of mine supply, and that real gold never touches that. But that's what sets the price. And people say, oh, it's manipulated. It's not really like that. It's not like manipulated. It's just highly financialized. It's a highly liquid market, and there's like tons of physical, tons of futures, tons of options on futures. I mean, it's like really, really moving all the time. And that's why when that move happened on a Sunday night, you broke into new highs. When you saw it rip right back down, it's because there's a lot of money to be made in gaming those moves, and there's a lot of people doing it. And frankly, they're a little bit more active than if you're at home, using like a Quest trade account. It's like these guys are moving a little faster. So I mean, they got like hundreds of Bloomberg terminals, and they're up all night in Asia. I mean, you met your match. But my point is that as we move to these levels, when you look back, it's like pretty obvious. I mean, this is it's a pretty strong position the chart's in.
Okay, and keeping in mind that for gold, you do have that long-term focus. You're in it for the long term. What drivers are you looking at? You mentioned maybe we can talk about that. So let's look at 2024, what you're paying attention to.
Yeah, so I mean, I think everybody's like, the Fed's going to reverse their stance. But the thing is that they're not really, so like, I think people misunderstand that the rate that they set is not really that important. It's like they've set the rate at, say, 5.5, 5.25, 5.5. But the 2-year Treasury is substantially lower. The 10-year Treasury is even lower, right? So it's like, is the rate really matter? I mean, is that really what's going on here? What they've been doing is they've been draining the system of liquidity. That's what they've been doing. And so they use that rate to corral that money they printed, and you see it in the reverse repo market, and they've been pulling that out. It's down to $600 billion, started at $2.2 trillion. To make things simple, don't be thinking at home, this is too confusing. It's not. The balance sheet got to $9 trillion. It's 7.5 now. So it's exactly the same number. That's what's happening. They want to pull all that out. When are they going to do it? It's very easy. It's $90 billion per month. So by the summer, it'll be out. And that's why I say that I think the target will be hit in the summer, because as that gets down low, things will start rattling a little bit, and then they'll come with some new. It's a very managed system. It's very managed. Don't be thinking like they're in there studying inflation, trying to help you. This is a managed economic system, and it got a little hot a few years ago, so they had to dial it back.
Yeah, and that's another point that I want to follow up on from the previous conversation. Is you had told us we're heading for this big reality check. Q1 is probably when it all hits the wall. So maybe we can take a closer look at that now as well, since we're in Q1.
Yeah, it's very tense. I mean, we're in the beginning of Q1. You know, we just come out of we have the whole Chinese New Year happening now. We came out of the U.S. New Year, Western New Year. I mean, you have this periods of like, what's everybody doing? I mean, you hit an all-time high in the SPY. It's one of these times where like, everything's trying to settle. You know, this is not normally a time when you take a big position. And so I think what you'll see as this quarter drags on is that there's a lot of things that are getting very tense. I mean, there's a story last week where Blackstone quit paying the mortgage on a office on Broadway, not their office, but an investment property, and the loans being sold for 50 cents on the dollar. I mean, all this stuff is starting to like build up. You're starting to see all this, and then that's at the same time going on with the U.S. Election cycle, which gets things very tense in the U.S. We do a real street brawl is what we do for the actual cycle of presidential nominees. But basically, all this stuff's happening now, and as that repo number goes from started at 2.2 trillion at 600 billion, it's going to go to zero. Zero is where it started in 2019. Before the pandemic, it was zero. So it went to 2.2. That's exactly the amount of money they printed. Okay, so that money went into the system, keep things going. Now they pull it back out. So the math works where, by end of March, you should be somewhere around 300, billion. And so as you get closer to zero, I mean, 100 billion is basically zero because there's always something moving around in there. But it's like, 2.2 trillion was excessive. So anyway, that's what I think the deal is. I mean, like, let me give you an example. I always tell people, they're like, I got a huge tax bill. I mean, I have a huge tax bill. So like, I don't want to be trying to come up with my tax payment March 31st, right? It's like, I don't want to do that. I mean, this is too much. When I look at this stuff happening, I'm like, I want to be able to chill out, for a few months, because what's going to happen is that when this thing rattles, the market is so heavily traded. It's not stocks. Like, people don't get it. People don't really trade stocks. It's all derivatives. So like if a hedge fund wants to buy stock, they don't actually buy the stock anymore. They buy options on the stock. They buy a synthetic version of the stock. And then dealers have to hedge that. That's what creates all this volume. So you have this giant ball of air. And it's like, when this thing goes in a little bit, everything gets wobbly. So when it's wobbly, you don't want to be like, well, I got to pay for my kids' braces or something. I mean, it's like, you don't want to do that. So I mean, you want to kind of look at this and say, this is the way this game's being played, is that we have these occasional panics, these like rough periods, very brief. Remember the COVID thing was like 3 weeks. You lost a third of the value of the stock market in 3 weeks. And then all of a sudden, boom, shot all the way the other direction because of something the Fed did. That's the pattern here. Even 2008, remember, it was like, things happen really fast and then turn. It's not a real market. A real market, you would work through a recessionary cycle. You would work through bank loans and, you just do all this stuff. You don't do that anymore. It's like you party till the cops come, and then you like shut down for 30 minutes so they leave and then boom, you party again. That's what we're doing here, okay? So forget about like the moral implications. Like, don't even worry about that. It's just that, like, how do you survive? How do you work? How do you save? How do you invest? How do you live in that environment? And I think that's really what we're talking about. Things in Vancouver, as you know, are pretty dry. Like, I mean, this is a city built on speculation, and you can feel it in the real estate market. In the real estate market, they've only had 1 year of high rates. I mean, 1 year of difficult. Imagine if they had to come to the gold market, and they'd be like 10 years between bull markets. But basically, people lose sight of that. How do you put your finger on the pulse of that? Ask any. I just had lunch with one of our brokers. I mean, it's like he'll tell you it's like slow. Now, I mean, it doesn't mean there's nothing happening. It just means that like you don't want to go out and fish for one fish. I mean, you want to go out and fish when the salmon are running, because it's no good to catch one fish accidentally. I mean, it's like you want to fish when the whole population is coming upstream. That's when the fishing is good. That's what you want to do. And so when we turn that corner, I think that's what's ahead. And until now and then, you want to keep your head attached.
Okay, so to be clear, just so I understand, hopefully Q1, we are proceeding toward this crash-like scenario.
Why don't we just say feel things rattling? I mean, I'm not sure we're going to have a crash. I think when things rattle, it means something like a merger can't get done because of the financing, or a commercial loan that's big, like a major commercial loan can't roll over because the liquidity is not there, and there's headlines of, will Blackstone have to whatever, and this type of thing is like rattling. So a crash, is kind of a different circumstance, but like this rattling is a problem because the system in the U.S. is totally dependent on more money flowing in. And so money's going out right now. It's going out. It's going out $90 billion a month out. And what I'm saying is that, when you hit that floor, the Fed, so you can track the Fed's repo, you can track the Fed's balance sheet, whatever you want, at the Fred website. It's so easy. They made this the best thing the Fed ever did. I bet you the Fed balance sheet gets to $7 trillion and there's a turn. I bet you that's their target. It went to 9 after the pandemic, and I bet you it goes back to 7 before it goes again. Let's not forget, in the 90s, it was $400 billion. Okay, so it was like 22, 23 times bigger at pandemic. So every time it goes up a little, it's like a stock chart. And people, okay, so what I notice always at like conferences, people, it's like they don't understand what's going on here. It's like the thing is going up, like it's going up. When they want to short the market and stuff, I'm like, good luck to you. It's going up. Maybe it goes down. I doubt you'll be able to guess when, but you come back in 5 years, it's up. Your house is going to cost more. It's like your grocery bill is going to be more. It's not really like inflation. It's that you've just got the trajectory when you're pumping money in is up. That's where things go, is they go higher. And so I think people need to try to play the short term carefully, but also be playing the long term. You want to buy things that are going to go up. I mean, the gold market is smaller than it was 25 years ago. I mean, it's like Hershey is the size of Newmont. I mean, think about that. It's like candy bar versus gold bar. I mean, Hershey and Newmont. I mean, which one would you rather have? And people here say, oh, I'd rather have Newmont. But like, look, I mean, Hershey, it's kind of a monster. I mean, it's pulled back because of the Ozempic. Everybody's afraid that nobody will have chocolate bars anymore. But I don't think it's true. Chocolate is delicious.
It is. Yeah, I could support the chocolate.
There you go.
Yeah. Okay, and so again, if I'm understanding properly, so for you could, if you wanted to have a difficult time, you could try to trade this, but for you're looking more to get through the turmoil, get to the other side. And the suggestion you gave back in October, generally short equities, long energy and precious metals. And so I wondered, is that still the way you're approaching it? And can we get any more details on the energy?
I'm shocked about energy. I mean, I'm okay. So I'm stunned. You got the Houthi rebels, firing rockets at oil tankers. Oil tanker rates are way up. Okay, like because you can't go through the Red Sea. I mean, you got to go. The Suez is like off limits. You got to go all the way back down. Around South Africa and up the side. It's just crazy. It takes like way too long. But then gas prices are cheap. I mean, in Florida, it's $3.50 a gallon. There's as much gas as you want. There's no way you can even use it all. And with oil, so in the newsletter, Tucker letter, we did a big thing last year on oil service stocks because they're super profitable. It's like they're debt free and it's amazing. And I'm just stunned that like we haven't really seen that. The people are so negative on oil, that it's like you can't even look at like an offshore, service company or whatever that's like super profitable. It's busy. They have like backlog. They can't even do all the work, and it seems like really really cheap. So I mean, I'm hoping oil doesn't go the way of gold. Which the gold miners have stayed largely debt light and profitable for years, and still don't really have anyone trading them. So the problem with shorting equities is like you have some things happening, these big shifts. Like, I mean, we did some chip stocks in the letter last year and they've really done great. And we'll probably do some more, so people at ebtucker.com, they can follow this. But the thing with the chip scene is that like you have this geopolitical factor in the chip world where it's like the American companies are just like they outsourced. It's like they don't have anything. I mean, it's like if you didn't have a kitchen in your house, and then all of a sudden, all the restaurants went away, and you got to rebuild a kitchen. I mean, it's like you want to be in the kitchen business, because everybody's done this. And so that's what happened in in the chip scene. And so it's really hard to say like I'm going to short equities because I don't think, I mean, everything in this room involves chips, and it's different from like saying it involves copper, because the chips are something that now we see as like a military asset kind of. I mean, like you don't want your enemy having all your chip capability. And so it's really complicated. I mean, so and I think you just have to be careful with the sector. But I do think I will be stunned if like there's not some sort of repositioning in energy, because it's a big problem. I mean securing supplies and it's just a really big deal. And I think we still need quite a bit of. I do think we're entering an era where the fossil fuels are not really. It's not like so simple to say, oh, we're not going to use them anymore. But it's like, well, I mean, you are moving into this new zone, and it's important to realize that like we want to invest with that mindset that we are shifting into something new, and that's a real thing. So.
Yeah, on the note of energy, I think one thing I'm hearing a lot is we'll need all types of energy. So when you say energy, are you looking at just as oil and gas?
Yeah, mostly. That's right. I think some of the other areas have been really hard to invest in. It's been really difficult. And so I'm not a big fan of making things like super, super complicated. I mean, like the uranium trade's hot right now. It's just been, it went to sleep for about, I don't know, 12 years or something like that. And then it got really hot, so it's kind of like things will get hot like that. I think you can, there's a way to play that. But there's so many different things going on. I think you have to pick the easy money. Like we want to play Babe Ruth style, where you lumber up there and like knock one out of the park. I mean, you don't want to like fight it out every single day. It's really difficult, and so there's other things happening in energy. I mean, like for instance, the whole battery mechanism is changing for the cars. I mean, it's just like to kind of like stay up and to play that as an investor that's not multinational. It's very challenging.
Okay, we will wrap it up just in a minute. I want to end by asking you, I think, just any final advice, actionable advice for investors right now?
Look, I mean, I think people have a hard time understanding that you're not going to live forever, right? So I mean, like this is like a really good time. Okay, I mean, you fast forward 5 years, and your movements are going to be more tracked, not less. Your money flow is going to be more tracked, not less. You think your kids are distracted with their phone now? Wait till your grandkids have an implant in their brain. This is your life. I mean, like, you got to do this money stuff. You got to do this investing stuff. You got to do some work stuff. But like, yeah, live. I mean, seriously, like, I'm not trying to be like hokey about it. But I mean, sometimes I'm thinking with people, I'm like, what are you doing right now to live? I mean, you're at an investment conference, so it's like you're learning. You're at the next level. You're already running faster than your peers. But like, don't forget to live. And what people don't understand, Charlotte, this is like really important, is that when you do that, your investing gets better. Because you're not sitting there thinking like, once I do this, 10 bagger, then I'll really start living. It's like you can live now, and you can do the 10 bagger. I mean, you can do all that stuff, and you'll actually spot the trend. People don't understand that about me, but it's like I'm really loose on these things. Like I do a lot of like different stuff, and I write. I write all the time, and I love it. And you spot things when you're not absolutely determined, and like you got your head in the books, all the time. I mean, you have to like keep your mind free and live your life and take that trip and do those things, with people. And then you're going to become more successful. It's like my friend encouraged people to take Friday off. For instance, he was like this counselor guy. He's like, take Friday. People are like, I won't make enough money. He goes, you'll make more. Because what will happen is that you'll find that your life becomes more effective when you loosen up a little bit, and do these things that you enjoy. And I think people should really, we're going to get this right. Don't worry. We're going to get this type of thing, like this thing we're doing here. It's just really good. We're going to come out ahead of a lot of people, and that's going to be great. But like on the life stuff, get busy living.
Yeah, I think people really appreciate hearing those bits of life advice for you, and it makes total sense. If you take a break, then you have more ideas, more to put into what you're doing. So thank you so much. Very good. Once again, I'm Charlotte McLeod with investingnews.com, and this is E.P. Tucker with the Tucker Letter. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.